Okay, we have a big problem. And honestly, Jerome Powell has an even bigger problem. Following the economic data that came out this morning, take a look at your PPI report. This is Producer Price Index. Essentially, you have CPI and PPI. PPI is the producer cost, okay, like a Nike's cost or a Tesla's cost or any other company you want to throw in there. That's PPI. How much are companies' costs going up? The theory is if company costs go up, consumer costs likely go up afterwards, but PPI tends to lead CPI. This morning's PPI report was, quote, red hot, according to Zero Hedge. PPI month over month on a headline basis came in at 0.4% month over month. The expectation was 0.2%. Honestly, I'm shocked by that because energy was pretty well behaved last month, and that tends to be one of the bigger input costs to companies. So I'm shocked a little bit by this headline report. Your core month over month is a lot more tame, coming in at 0.2% month over month, meeting expectations of 0.2%. But that was the only thing that was tame about this report. Headline PPI year over year came in at 3.4%. Expectation was 3.2%. Not a good number. Core PPI month year over year came in at 3%. Expectation was 2.6%. So pretty much across the board, besides core month over month, came in way hotter than expected. At the same time, initial jobless claims came in at 242,000 for last week. Expectation was 220,000. So yeah, that's a bit of a problem because you have a weakening economy and hotter than expected inflation dynamics in the CPI report and the PPI report for last month. Continuing jobless claims could be an even worse signal because they continue to go higher. You came in at 1.886 million. The expectation was 1.877 million. Okay, so even hotter there really does not look good. Liz Ann Saunders here shares the same data that we just went over, but the greatest increase was in California, up 14.8 thousand last week. Texas was up 9.5 thousand, and New York was up 9.2 thousand. The greatest decreases were in North Dakota, down 780. Delaware, down 170. And New Hampshire, down 2. So you're going up almost in every state. Now, Guy Berger over here says some of it may have just been that seasonal adjustment that you see have some issues around the holidays. Okay. The seasonal adjustment was quite a lot this past week. Non-seasonally adjusted numbers, in fact, you would have come in at 310,000 initial jobless claims for last week. So it actually helped out to push those numbers down a bit. But if you look at this chart here of initial jobless claims, this is the biggest weekly increase since early October when you were having some of those growth concerns. And over the past couple of weeks, it definitely looks like things are starting to spike again. And let's consider this is in the holiday shopping season. Just imagine what these numbers could look like after December. That's where some of my concern comes in. Peter Burskin with BCA Research, keep in mind their price target for next year is about 4,600 for the S&P, which would be about 460 on the SPY. He says, I would downplay the spike in initial unemployment claims this morning. The seasonal adjustments are very tricky at this time of the year. The continuing claims data looks more concerning, however. And if you look at continuing jobless claims, that is up 14% versus 2018-2019 levels. And again, you're in the holiday shopping season, which you don't normally, expect to see data this week, this early into the holiday shopping season. After December into January is where things could start to look even worse. And Kathy Jones says, yeah, we missed on initial jobless claims, but when you look under the surface, all regions experienced a fairly large increase. Now, is this data really going to crash our markets or anything super extreme? between now and year end? Probably not. And if markets do further extend higher from here, I think that just means you're going to have a larger correction in Q1. I've been under the same narrative now that it's really just about knocking out your risk catalyst. Next week with the Fed, that's another risk catalyst, and that could set us up for that end of the year Santa Claus rally. But the dynamics under the surface are deteriorating. Higher CPI, higher PPI, higher initial jobless claims, higher continuing jobless claims. That's not a good backdrop to fall back on when things start to turn negative for equities. As Ryan Dietrich over here on X writes, December is a strong month, but the majority of the gains happen in the second half of the month. Around December 15th or so, you tend to hit that lull. And then from December 15th through the 31st, on average, the S&P is up 1.48%. You tend to get this year-end rally in December, not in the first half of the month, but in the second half of the month. So if that happens again, well, it probably will, let's just be honest. It does set us up again for a larger correction in Q1 of 2025, which is my current projection. Seth Golden writes on X, a little compare and contrast versus now and 1999, early 2000. He says, relentless rally, yes. Melt up, yes. Constant rotations, yes. High valuations, yes. Back-to-back 20%ers, yes. Frothiness, yes. Warning signs brewing, no. He says there's a stark difference between the 2000 bubble and today's 8 bellwethers validating of the bull market. Look at the New York Stock Exchange advance and decline line. You can see a noticeable difference in all of these charts. And yes, the advanced decline line for the better part of a year before the dot-com bubble actually burst was declining. Today, it's been going up for the better part of a year. And all of these charts on the left side, which are the current market, look a lot better than obviously 1999. So a bit of a comfort for some people that have been concerned of another dot-com bubble-like crash. Funstrat's Tom Lee says, on the heels of back-to-back 20%ers, the SPX finds 7,000 by mid-2025, but finishes the year at 6,600 as tariffs, Doge, and animal spirits reignite in the second half of, or resign in the second half of 2025. And this is his base case for this, rally into mid-year and then sell off in the second half of the year. He says, for the thesis, 2 puts make it right. Fed put as inflation eases and the Fed focused on supporting employment. The Trump put as White House implements policies to boost confidence in EPS. Reallocation of investor capital from cash and bonds to equities. The tale of two halves after back-to-back 20% gains. 5 precedents since 1871, cumulative 4 years up 69% versus 2021 through 2024, up 27% with 1 year left. 4 of 5 precedents saw stocks fall the third year, only positive was 1996, and 5 of 5 precedents saw stocks do worse in the second half of year 3, which would be 2025. He writes here, what could go wrong? To us, the downside risks are that Doge is too effective and GDP falls on spending cuts, and tariffs are actually implemented and GDP is impacted. As far as actual fundamentals, they see 2025, 2026 EPS growth at $275/$300 for 2026. Year over year, that would be positive 13% earnings growth next year and 9% in 2026 with cyclical driven EPS. Corporate CapEx fell the past few years, but easing FCIs mean CapEx can recover. Potential GDP recoveries in Europe and Asia, and weaker USD suggest upside to EPS. Also, productivity is improving. For PE expanding in 2025 towards 22 times 2026 earnings. Since 1937, the highest PE realized when yields were 3.5 to 5.5%, and when between 4 to 5%, PE is usually about 18x, 65% of instances. His best ideas for next year is small caps number 1, financials number 2, industrials number 3, and anything Bitcoin related as number 4 here. 2025 S&P 500 target, mid-year 7,000, end of year 6,600, which is 22 times 2026 EPS of $300. Now for tomorrow, Friday, December 13th, we really don't have much for economic data. We have export prices month over month, import prices month over month, and year over year figures. This will go into a new estimate for the Atlanta Fed GDP, which is currently at 3.3%. Now, if we take a look at the latest AI investor sentiment survey that came out today, bullish investors fell from 48.3% down to 43.3%. So that's a good sign if you are, bullish on near-term prospects. You don't want to see everyone in the bull category, right? That's the last thing you want to see. Neutral investors rose from 21.0% to 25.0%, and bearish investors rose from 30.7% to 31.7%. So this actually looks like a pretty good report out today. The percent of stocks trading above their 50-day moving average is actually down about 1.43% today. So almost 1.5% of all stocks fell below their 50-day moving average today. It's not a great day out there for the average stock. Currently, 59.42% of all stocks are above their 50-day moving average. And yes, you have been trending up recently, but you're also kind of trending down. You're in this triangle pattern here, and we could see a breakout to the upside, is at least what it looks like to me, just charting this out a bit into year end. Once you get into the low 80s, mid 80s, or so is when usually euphoria starts to die down in markets. So we're not even close to there yet. And that would be suggestive of a year-end rally. CNN's Fear and Greed Index is neutral today at 52. Yesterday it was neutral at 51. So definitely a lot of room to run here if things do get more exciting for investors. Market momentum is greed, stock price strength, fear, stock price breadth is fear. Put and call options, extreme grade, market volatility is neutral, safe haven demand is fear, and junk bond demand currently in greed. If we take a look at CNBC today, the VIX is actually up 1% after it was down about 1% just about a half an hour ago. So that's fascinating. Some people are getting a little bit more nervous as markets are getting worse today, especially the Russell 2000. Russell is down 0.76%, NASDAQ down 1/3%, S&P down 0.2%, and the Dow is down 0.15%. So a bit of a risk-off move across the board. Bond yields are really accelerating as well into the end of the trading day. I should say the bond decline is accelerating into the end of the trading day. 10-year Treasury yields at 4.31%. After rising about 3 basis points yesterday, they are up 4 basis points today. So not exactly great. It seems like the PPI and CPI reports are holding more precedence than the spike in initial jobless claims that we've seen today. So not ideal, not in a terrible position either. If you look at what the markets are pricing in for Fed policy coming next week on December 18th, that is 6 days, 1 hour, and 34 minutes away from now. We have a 96.3% chance of a 25 basis point rate cut, a 100% chance of at least one rate cut, but there's a 3.7% chance of a 50 basis point rate cut, which this probability is down a little bit from yesterday, but up from the low of the day today, where it was only at about a 1% chance. So are we going to get a 50 basis point cut? Not with the CPI data that we got out yesterday and with the PPI data we got out today, but markets are leaning towards more cuts from the Fed, especially in 2025. So let me know what you think about all of this information down below in the comments section. Next big risk catalyst is the Fed. Once that is out the way, that could really drive the next leg for markets. So again, let me know what you guys think down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.